I am AI Abdarok CA Ratan Mundra. Welcome to this presentation on the AML and CFT guidelines for reporting entities in the virtual digital asset space. In this session, we'll explore the key regulations outlined to combat money laundering and the financing of terrorism. These guidelines aim to ensure transparency and compliance, helping organizations effectively manage risks in the virtual digital asset domain. The legislative framework governing these guidelines stems from the Prevention of Money Laundering Act, PMLA, and its related rules. These regulations align virtual digital asset providers with traditional financial institutions by mandating robust due diligence and reporting protocols. The purpose of these guidelines is clear: to promote fairness, transparency, and legal clarity in the digital asset space. These rules help establish operational readiness and ensure that entities understand their obligations to prevent money laundering and terrorist financing in this rapidly evolving sector. The guidelines specify the importance of appointing a designated director. This individual is responsible for overseeing compliance with AML and CFT regulations. The designated director ensures that internal mechanisms for reporting suspicious transactions are well maintained and that due diligence measures are followed. Client due diligence, or CDD, plays a critical role in verifying the identity of clients before establishing business relationships. This involves gathering necessary documentation such as identification documents, proof of address, and other KYC requirements. Reporting entities must ensure that clients do not appear on any sanction lists and continuously monitor transactions for suspicious activity. Ongoing due diligence involves continuously scrutinizing transactions to detect any suspicious activity. Reporting entities must have systems in place to monitor transactions and ensure compliance with AML regulations. Additionally, all transactions involving virtual digital assets must be subjected to strict scrutiny, including ensuring the necessary information is submitted for every transfer. Record keeping is vital to ensure transparency and compliance. Reporting entities must retain records of transactions and client identification for a minimum of 5 years. In addition, sanction screening must be conducted before processing any VDA transactions to ensure no funds are transferred to individuals or entities involved in illegal activities. In conclusion, these guidelines offer a robust framework for ensuring compliance with anti-money laundering and counter-financing of terrorism regulations in the virtual asset sector. By following the steps outlined in registration, client due diligence, and transaction monitoring, reporting entities can ensure they are not only complying with the law but also fostering trust in the rapidly evolving world of digital assets. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support and handling. Compliances risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance finance company, foreign university BATF and ancillary regulations, and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA comprehensive support, covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us